Hello, all you lovely people out there. How are you all doing? I'm Kate Hill, and I am here to give you the best commentary about our property markets. Tina Howes is with me from SmartMove, one of Australia's leading and award-winning mortgage brokers. We are giving you a whole series explaining all things property finance, so stay tuned. Hello everyone, I'm here with Tina Howes from SmartMove, one of Australia's leading and most award-winning mortgage broking firms. Now this time around, Tina wanted to ask me some questions and she's looking for some of my insights as a qualified property investment advisor. So Tina, tell us why we're here and what question or questions you have for me today.
Thank you, Kate. Now, obviously, people come to see me when they need finance. They've decided they want to buy a house or an investment, or perhaps they've gone and seen a buyer's agent such as yourself, and who said to them, well, we need to understand how much you can borrow. But what I really want to try and understand and hear from you, because obviously I've heard it from you for many, many years.
Yeah.
But the key question of what makes a good investment property. And before you jump into that, one thing I see typically all the time is people, when they want to buy, say, their first investment property, is they will generally look in an area that they know, because that's sort of the suburb that they know, and they think they know what is good in that area. But I guess I'm keen to hear how we can expand sort of outside that that realm.
Yeah. Wow. That's a big one. And I do get asked that all the time. So, you know, what makes a good investment? Where are you buying for all your clients at the moment? I get that a lot as well, right? And the answer will forever be, it depends on the buyer. I'm always buying, I shouldn't say I, there's a team of us, we are always buying in really great areas, but each of those areas is suitable for each particular client, right? Now, that's not meant to be passive, or not passive, but it's not meant to be vague or evasive. But as an overview, if I can put it like that, a good property investment is one that you can afford to buy. It's one that you can afford to hold. It's one that will grow in value or give you rental yield that you need, or ideally both. So that's a bit of a snapshot, if you like. Now, obviously, we will drill into that, right? Because I'm a firm believer that buying a property asset purely for rental yield is a bit of an opportunity cost, right? A good property investment is one that suits the buyer making the investment. Now, that does mean that you need a rental yield that, like I said, you can afford, right? You need to be able to afford to hold the asset. And there are, you know, hundreds of different areas around Australia. You know, they all have good growth potential. Not every area has good growth potential, but lots of areas have good growth potential. They have different price points. They have different yields. And by yields, we mean the rent to property price ratio, right? There are obviously different property types. And I really can't stress this enough. It's just not a one size fits all approach when we say what makes a good investment. You know, you can't just make a blanket statement and go, well, it's in this city and it's this property type for this price, you know, with this kind of rent, because client A or buyer A, that's going to look completely different to how it does for buyer B over here. So
let's say we have a buyer A that has a healthy amount of free cash flow. They want to have a property that gives them great yield and great capital growth. What would you say to that?
Oh, that's what we all want.
Can you have both?
That's what we all want. Yes, I think you can, actually. I do think you can. So, but what you said there is really key, because what you're telling me there is a little bit more about the actual client or the buyer's situation, right? So if we look, for example, at two different scenarios here, right? For like an example buyer for on an average income earner, and in Australia on a marginal rate of tax, so let's say 32.5%, right? Let's say they have a 2.5% interest rate on an interest-only loan. All of these things make a difference to that outcome, right? Okay, so you have a scenario whereby it's a $750,000 property. It's a newer style property, brick tile, relatively newish, let's say 10 years old or, you know, or younger. It's in a capital city and it's getting $450 a week in rent. For that buyer, the average income earner that we just talked about, that's going to cost them about $100 a week before any tax concessions. Interest only loan, 2.5%. It's about $100 a week. It's costing them. Excuse me. So, and that is borrowing the full amount of that purchase price. Scenario 2, it's a $500,000 property. It's a bit of an older one. Let's say in a regional city. All good growth areas, also getting $450 a week in rent. This one will actually make that person money. They will earn about $20 a week before paying tax on that income. So for the same buyer, two different scenarios, two different areas, two different property types. They both, let's assume they both have really good growth potential in terms of the areas, right? But which one would you choose, right? Now, if you're a higher income earner, then the outcome for both properties will be completely different. Right?
Yeah. So do you need to factor in, though, with the second example that doesn't cost you anything now because it's older? Is there likely to be more things to fix up and more money to spend?
Not necessarily, because sometimes those older properties have been very well renovated. So, and with the depreciation changes that came into effect a few years ago, you're not going to be able to claim anything on that property anyway, unless you're the one that renovates it, right? So you are, if it's been renovated well, then some of those older properties that are also, let's say, brick and tile, they are built like nuclear bunkers, Tina, and there is very little to do. Sometimes with the newer properties, you actually have a lot more repairs and maintenance to do than you do with something that was built back in the 70s and 80s that's been sat there quite happily. You know, like
they don't build them like they used to.
They don't build them like they used to. Exactly. So yes, so those two scenarios, the personal circumstances of the buyer in those two scenarios are really, really important. That's why you know, knowing what it is, knowing your situation and knowing what you need is really, really important. So having covered that off, and we are going to do we're going to have another conversation about what actually drives growth in what you're buying. We're just talking right now about what makes a good investment. I do want to cover off on some of those essentials of really what makes a good property investment. So, and there's a term that gets bandied about a lot, which is investment grade property. You don't really just apply that to property, you apply it to area as well. So now I'm going to do a bit of a shameless, blatant plug here. We go into this in great detail in our book, The Female Investor, which is available in all good bookstores. But as number one, as a sort of an essential, what makes a good property investment, it is one, I would say, that has been, how can I phrase it, clinically, like objectively assessed on its merits and suitability for you. Not because it's around the corner from where you live, like you just said earlier, not because your mates last night recommended it, because they've read something in one of those investment magazines, but it's been put through its paces, it's been assessed, you or your advisor, you've been completely objective about it, and check that it's right for you. So see all those comments I just made, right, about those different areas, property prices and the outcomes for you. So that is really, really key. You're not making an emotional decision. You are clinically assessing it, if clinically is the right word. I'm hoping you all know what I mean.
Mm-hmm.
Number 2 is the location, right? It might seem really, really obvious, but the location will absolutely do 70, 80, if not more percent of the heavy lifting when it comes to you getting capital growth, but also rental income and securing good tenants. So you don't just go leaping onto realestate.com or a real estate website out there, picking the property first and the location as an afterthought, or, you know, all property grows in value. It doesn't. I promise you, it can be your undoing. You need to do that research first. You need to find the best location, and that might mean it is not around the corner from where you live. It might not even be in your town or your state. And
what about the, you know, we went somewhere for a nice holiday and we think that we can pick something up in a nice area and Airbnb it, or...
Oh my God, can we do a whole other conversation on that one? Please don't do it. Please don't do it. That fits into the number 1 category. That property has not been clinically assessed. You have an emotional attachment. You had a lovely trip to wherever it is. You've relaxed. You've loved the lifestyle. You've gone, let's buy a property here. You haven't assessed the property on all the merits, you know, and all those checkpoints that we have to look for to make sure it's actually going to grow in value and make a good investment for you. And that is the conversation that will soon follow what drives property growth. Number 3 for now will be supply and demand. So again, it's kind of obvious. Demand has to continue to outstrip the supply of your investment so that your investment will grow, right? Not just for the area, but also for your property. So just to explain really briefly, again, I'm sure it's obvious, but when there is really high demand for something, but low supply, it will put upward pressure on price, right? We see it every day with oil, with bananas, with avocados, with whatever it is that there is currently a shortage of, right? Prices go up. It's the same with property. When there is low demand for something but high supply, then obviously the opposite is true, and prices generally will not be rising as much, and they may even fall. We saw this as an example during the height of the early COVID pandemic back in sort of June, July 2020, here in Australia, in Melbourne, and in Sydney, and in Brisbane, in the inner city unit apartment, because suddenly all the tourists had gone. All the demand for all those thousands upon thousands of units had gone almost overnight. Gone, right?
Yeah.
So those unit values dropped in price significantly. The rental yield of those properties dropped dramatically by $100, $150, $200 a week because people were desperate to get tenants. Typically, high supply, very low demand, right?
So the banks pulled back on how much they would lend you, if at all, in those areas.
That's right. Yeah. That's right. And I think some of those postcodes here in Sydney, sort of anecdotally, I think are still blacklisted, but for exactly that reason, right?
But fair to say, if you had deep pockets and you were a risk taker, that potentially some good value there.
Absolutely, absolutely. Especially if you're an owner occupier looking to get into that first investment into your first home, and you know you fancied a unit in a lovely sort of cafe society here in Sydney or in Melbourne. Absolutely, a golden opportunity. So that high level of property supply and low demand is obviously the buyer's market, right? Because there's a lot of stock to choose from. That can have in the shorter term a negative impact on capital growth, right? The lower level of property supply and high demand, which is what we've really been seeing across a lot of Australia in the last 18 months. It's the seller's market because there is not much stock to choose from. Don't we know it? So, and that will have obviously a positive impact on capital growth. Like I said, that's what's essentially been happening for 18 months in Australia. We've had very low stock levels and very, very high demand from people, you know, moving interstate, coming in, you know, buying up property because there's a lot of cash that they have to spend. So the location is key. You might be able to renovate or update that property, but you will never be able to change its location, right? And likewise, buying an older house, or buying any old house, I should say, in any location doesn't mean the house will grow in value, right? Because if you've purchased the house in the wrong location, you might find that its value just doesn't increase that much, because there are a number of issues, such as if there's a master plan community nearby, there's a declining population, or it's just positioned on a busy road, or whatever its issue is. So from the supply and demand perspective that we're still talking about, right, you need to buy the right property type for that area and for the local people who live there, and in that area that has the best chance of capital growth. That's kind of the best way I can think of to sum those things up. Those are really the basic criteria that we're looking for before we drill into any further nitty-gritty. Does that make sense?
That's like property investment 101, right?
It is. It is. It is. Love.
Yeah. I mean, there's obviously so much in it of what makes a good location.
Yes.
Why do people want to live there? Who's going to rent my property? Who wants to move there and buy it as an owner-occupier? All those things. But I guess you'll go into that.
Absolutely. But those are the things that create the demand, right?
Yeah.
Those are the things you need to know about that location, so that you're buying in a location that's in demand, but also the property that's in demand. There's two different things there, right?
Is that $100 a week out of pocket or $20 surplus a week means nothing if you have no tenant.
No, that's right. That's exactly right. Yeah. But you'll feel it a lot more if you've got it as $100 costing you $100 a week before your tax concessions. You'll feel that a lot more than a property that's essentially making you money, where you can admittedly only $20 a week, but that is an opportunity for you to build a little bit of a buffer while you do have tenants. For if circumstances change. Which brings us sort of almost full circle back to a previous conversation that we had about building buffers and paying your loan off quicker, right?
There you go.
I know.
It's all related.
All interconnected, people.
Absolutely. Oh, thank you, Kate.
That's all right. Like I said, we'll do more chats soon, because I think there's definitely a lot more to talk about, certainly when it comes to what drives property growth. For us to talk about, but I think we'll leave the lovely people alone for now. So thank you for joining me and asking me hard questions. I love it.
Thanks, Kate. Thanks for
we'll see you all again. See you all again soon. Bye.
Bye.
I really hope that you found all of that useful. Tina is a mind of information. She and I will bring you lots more videos explaining all things property finance. Don't forget to leave us a comment and a question. And don't forget to hit the subscribe button, and also just give us a little like on the video if you are enjoying the free content. And we will see you really soon. Bye.